Can Exxon maintain that dividend?
So they've stated, as a matter of policy that this year they don't need to issue any more capital, debt or equity to cover the dividend. You're right. A lot of it has to do, there's a lot of attention paid to near-term movements in oil. Our estimation is that for 2021, Exxon would cover the dividend organically at around $50 Brent after announcing some spending cuts and some more expense cuts that we expect to come. That's before asset sales, so they could also sell asset sales. They could also sell assets to fund some of that payout. But every day that oil's below 50, you're probably going to see doubt expressed in Exxon stock as to whether the dividend is sustainable. We think it is, but we can't convince everybody.
All right, Sam, I'm curious. You talk about those other strategies, including asset sales. If a company like ExxonMobil or hypothetically a Chevron or some other oil major in the world sells assets, who would be buying them?
So the trend that we've seen, there's been a long trail of asset sales, even from the start of the crisis. And the trend that we've seen is that operators are typically able to sell assets to local companies. So, for example, Exxon sold its production in Norway to a Norwegian company. So local companies at the nation of production are incentivized differently to spend there and keep production stable. And so there's typically an appetite from a domestic company at any given production country to take over assets. Now, price and valuation come into play too, but that's the pattern that we've seen, is that where the market's open is where you can sell production to a domestic company from where that production is located.
All right, so Sam, where exactly then in your coverage universe within the oil and gas sector, which dividends right now appear the safest? You mentioned ExxonMobil. Is Chevron safe? Are the other big exploration and production companies safe? Which ones are the relative safe dividends versus ones that could be cut?
Chevron appears to be the safest dividend. I think Exxon is safe too, but just by the numbers, Chevron is safer. What differentiates Chevron is the fact that it has the least amount of debt in the sector. And so, worst case scenario, they have the capability to issue more debt to pay the dividend until the market clears up and cover their expenses that way. And they could do that for 3 years at $30 oil before they're even at a peer group average of debt load. So that's how little debt they have relative to the industry, and that's what gives them the runway of dividend safety. Having said that, though, if the hurdle is $45 to $50 oil, we actually do think we're going to be there next year. It might be a volatile process, but the fundamentals line up to that level.
All right, so let's talk about then some of the other companies besides the major integrated ones. Is it refiners that are safer? Is it the oil and gas exploration production companies? Is it the oil field services companies? It seems that all of them are levered in certain different ways to the price of oil.
That's right. And you could even drill down further than that. I'd say refiners specifically are the most exposed to these demand fears that you referenced at the beginning, right? Refiners are closest to the customer within the value chain. So if demand is the issue, then that's probably going to impact refining most sharply, because the industry will adjust its supply at a slower pace. Integrateds, the major oils, also have exposure to some verticals that are actually really working. In the petchem space, demand is increasing for medical tools and supplies that are consumers of polyethylene and other plastic products that are made of oil and gas that the major integrateds are exposed to. So by and large, it feels like the integrateds have a cleaner exposure to a more sustainable dividend than just a pure demand play in the refining space.